Simple thing, 12, 15 slides, Europe, Germany, Frankfurt, and then I hand over to the panel. Again, I think what's an interesting topic in my little world is quite simple. I can show you the Q1 figures, which are finally now set up. On the other hand, we have the best guess for Q2 figures, which means by mid-July, third week of July, we can find a general harmonization, how the Q2 will really, let's say, work. Positively, negatively speaking, I don't want to touch too much on these things, but I think interesting for you. Best guess yesterday evening, best guess mid of June, so missing 2 weeks. And I think when you read the Thomas Daly this morning, you see that Theodor Stanka is sold now. So again, a big thing, which is not really predictable in some cases. Anyway, big thing, which means office, retail, industrial, hotel, residential. So all in what we call commercial, the big piece of cake. We focused this around 130 billion on that. And again, and this naive projection, if you double it, then you come close across to the year 16, which is a guess mid of June, so we're still facing 6.5 months. But anyway, I think digging a little bit deeper, which is the next slide, but the most interesting thing for me is that the big three, so UK, Germany and France, they fell us like a little bit, while other ones like the Nordics on a minor level, but also Spain, Iberic Island increase in some cases dramatically, positively speaking. When you see here these figures, this again Q1, and I unfortunately have to read now the new one, the Q2 estimations, which is then the first half year. Germany will be then not around 20, it will be 37 billion. Best guess for end of June, so 37. UK will be 29, best guess. We call turnaround Europe, which is Ireland, Portugal, Spain, Greece, Malta. Turnaround, which means they were, everything knows, heavily hit by the financial crisis around 10 years ago or 8 years ago. So best forecast is then 9.2 billion. And I have to mention this, the 9.2 billion, this is of course driven by two main countries, which is Spain and Ireland. So this is again a double-digit investment increase, especially in Ireland. The evolution in Spain starts, as you all might know, 4 years ago. The Benelux then 7.5, slightly decline on that. It's depending more on the investors' activity, especially on resi in the Netherlands, which is always linked to the local law on that. France, 7.9, so close to 8, which is then nearly double the size like Q1, so it's in line. I mentioned this because Q1 was, compared to the rest of the big three, it was, let's say, poor. It was not as expected, covering whole Europe on that. But again, it was the Macron effect. We will hear later on that. But again, we're still optimistic that France will reach close to the 8 billion level for within 2 weeks' time. The Nordics, Catella is a Nordic company, so you can imagine, and there's absolutely no secret, there is absolutely in-deep knowledge on all the 4 markets plus Iceland. It's fantastic, especially for a researcher. You can dig wherever you go. It's so transparent, these markets, and so the best guess from 3.5 will be then 7 billion euros invested in the 3 sector, dominantly driven, of course, by the office one. And again, it's a mix of a lot of these currency, which is Finns, euro, the rest are the kronos, but also some things like exotic. When I call exotic, then I mean in the case of Norway, which has a totally different structure and style of investments than maybe Finland or also Denmark, which is more a minor market. Central Europe, 3 billion, then it's now 5.9. Austria, Switzerland, 1.6 to 7. There was a big one last weweek in big in these countries, close to Vienna, and then Eastern Europe 1.1. I have no figure on that because there is absolutely no clear picture. Of course, it will be higher, but I wouldn't give a best guess, as there is a really huge intransparent case from an investor's approach, starting in Romania, interestingly speaking, and not in. It's not Poland, by the way. It's the rest of that. Russia, not really measurable these days, to be honest, but it's mainly Romania what we see, and not Bulgaria in the former old definition. Just again, set up the scene. A lot of data, I know, aware of that, but on the other hand, if you see this is of course coming from a purely international view of that. It's Germany, it's UK, and it's again France. These are the big ones. I mentioned this because a lot of these strategic rounds starting in November every year, where the big top 100 asset managers look on this planet and say it's Australia, Pacific, it's Europe, and then this is Europe. I'm a little bit cautious, especially when it comes to Italy. Maybe we'll have also discussion on that later on. It's not as worse as it seems. Just reading the headlines on these, let's say, shaking banks, from the fundamental of the real estate view, I think it's a healthy or robust situation. Maybe we can touch this point later. And again, when I talk on Italy, to be honest, it's this and a little bit that, which means Milan and Rome, but that's it. Otherwise, it's depending on your probably risk profile, so I wouldn't quote that. Maybe we'll spend your Sicily, your holidays. Anyway, German markets, again, same structure. A lot of these, let's bring it to the point. I think as you are all in the market, you know that there is still an increasing scenario. By the way, 12.15, it's exclusive resi, so this is just commercial. Mention this again. Minus 3%, the yield still 22. We forecast 25 this year. Anyway, best guess for Q2 will be 3.05. This is again where all the predictions from the researchers are fantastic. So we were really get close to the 3.0 level. Retail is slightly a little bit higher, again, slightly decline on that. And when it comes to the so-called secondary or in famous German B locations, 5.4. Best guess will be 5.15. We go under the 5%, not in my lifetime. Otherwise, then it's a bubble. Quote. And then again, the logistic, which was heavily invested the last 24 months, positively speaking. On the other hand, I think some are in the rooms which make the last cycle. And then when we talk on this market environment, logistic was in former days 6.25, which is a totally different structure right now. And again, making also a statement on that, realistically and self-critical, I have no idea, meanwhile, what is behind the logistic market. Not driven by investors, but in real time, what is logistic property, industrial property, what is that? So meanwhile, we separate 8 different classes. This makes life not really easier, just to focusing on one figure. So this is a wide spectrum. There are, no doubt, logistic properties across Europe where you find a 2.75 in. This is just give you an indication what's the wide spectrum meanwhile. So don't punish logistic as it's too hot, but you really have to understand what's really behind the scenes going on. Next thing, the commercial transaction. And okay, it's office and retail. I think this is the traditional thing. Last 2 years, resi, which is not here, rockets up. But I want to touch my beloved point. This is the called mixed use, and just seeing around here, but wherever you go, meanwhile, when it comes to refurbishment or constructions, there is absolutely no 10-year lease with Linklaters and the city center, except for this maybe. But you have all these mixed-use properties coming now to the markets. It's the most interesting thing for all of us, positively but negatively speaking. So again, the big thing is of course a lease in the office block, but this is the new world, especially when it comes to these city center developments for the next 10, maybe 20 years. Resi in the top, working in the middle office, and then maybe shopping or retail or whatever in the basement. Simple thing, but this is again where just look around, you saw the wonderful terrace, what you see when the cranes are. There were just few 100% office blocks. This will come to an end in my understanding, and so we have a dig a little bit deeper also from the transparency case when it comes to these mixed-use thing. Interesting thing, and I think there are a lot of things. Summer break starts last week here in Frankfurt, especially in Hesse, but when it comes now to this prediction, this is our conservative forecast. Slightly slower than last year, but you see this revision of share deal structure in Q3. I think this is again more sentiment driven. Everybody's aware of the change in the law. It's more a soft change, to be honest. It's not that dramatic hit, beside all the headlines and lobbyists from our side, no doubt. But if you bring it together, I'm strongly believe that there will be kind of a forward pulling effect, especially when it comes to July, August, and September. So hope you have booked your holidays, and hope you will find a plane or a car next week. If you do, but it will be, let's call it, it will be a hot summer for mid-sized companies who try to bring the egg in the basket before the share deal case hits. Maybe Carsten and the audience will take later on that. So when I say this is a conservative, I'm not that optimistic that it will rocket up super like '07. But this is again where I see more activities in the market than we expected at the beginning of the year. And self-critically speaking, I wasn't really sure that the share deal case will really happen end of last year when discussion, especially with Mr. Chavez and Hessia, started. Anyway, but again, it's more a soft discussion than the big hit. But I think our industry can benefit a lot of these things coming up, but don't get nervous and start mooring when then the Q1 19 maybe is a little bit negative compared to Q1 on that. Anyway, anyhow, still optimistic. Good. Retail transactions slowing down, just again these things. Last year, this Q1 was Munich, then followed by Frankfurt and Berlin. Interestingly speaking, that the traditional ranking, it was the last 3 years, it was just Munich, and not Frankfurt, which was the number one for a long time. And again, it's still a robust situation. There is a slightly decline on that, but if you look on Q1 17, so 18, again, it's a let's say double-digit expectation, which is quite good. Focusing again office, then followed by retail, and then it's interesting. It's the industrial case, which I mean on that. What you don't see here, because we don't cover in this slide, Resi. It's compared to whole Germany. Meanwhile, on number 3, coming from number 7 tradition-wise. So Resi, it's meanwhile a more commercial thing in our environment, more than ever, than let's say the hotel or what we call the others in former time. By the way, the others are sometimes these mixed-use things. Anyway, interesting thing. Now it comes also to a slide which I have absolutely no idea, because I look nearly every day on Mr. Draghi's tower at the East End, and he will go to pension in end of September next year. QE starts or stops by end of this year. It's again still 0 level, which we all know, and this is of course room for discussions, but also for super predictions. What happened then when Mr. Meitmann, the strong, robust, rough German, will get on power with we have to increase interest rate? Yeah, well, it's the headline, of course, in Germany, but I have absolutely no idea what will happen when Mr. Draghi goes in pension. What will happen, of course, and this is our prediction, we expect a slightly increase in the interest rate side before Mr. Draghi will go back to Italy or Sicily, or I have no idea. So again, we expect by mid of this year, it's more, I would say it's more simple that ECB acts on that what we saw the last 2 quarters, 3 quarters coming from US. So I see it more a symbol, not an irrational symbol, but it's the ECB will start maybe mid of next year a slightly increase on the interest rate under the flag of Mr. Draghi. Best guess, Thomas Beyerle this morning, maybe tomorrow I failed totally. Anyway, but again, and this is again, of course, our beloved chart, as long as we are on the fundraising side showing to clients, you see that the yield gap, which is 200 basis points, it's still an attractive, super attractive environment. And again, I mentioned this not due to advertising reasons, but if we all go back into the so-called good old days and good old times in '07, you see what happened. There was really a fight between a 10-year treasury bond and that real estate brick and mortar business. Nowadays, it's maybe more easy, let's say this. So don't get mooring when it goes down to 5 and 4%. Think realistically, what is the benefit you can get out of this? And again, it's still a slightly positive environment. Again, summarize now with the Frankfurt market, where we are all in, I hope so. Again, situation in this bar chart, it was the Theodor Steinke wasn't included, as you might know. But this is a conservative thing. I'm quite optimistic that we don't overrun the 7 billion, but I'm optimistic that it will be slightly a little better than last year. We will maybe have a chat on mid of January next year if this was a good prediction. And this, I think, this shows you the structural shift on what's going, and the discussion, the lack of product. I'm not so sure if this is really that big lack of product. There is, of course, a lack of product when you cover a whole market, and especially when it comes to city center. But you will see later on, of course, the big development pipeline, which is a fantastic thing. Not coming to this vacancy case when it's development and the last phase of the cycle, but positively speaking. Anyway, seeing the yield differentiation between CBD and what we call decentralized location, which is included Eschborn and also part of Kaiserlei. It's all in line, so no doubt. I see our mooring, no doubt. But for me, this is the most important thing from an analytical standpoint. If there are around, let's say, 100, 120 basis point difference between in and out, between A and B, between C and D, then it's what we call, generally speaking, a healthy market environment. I don't talk on property level, I talk on the market thing. I mentioned this because in 2007, I just looked on the figures last day. Tokyo, Johannesburg, Frankfurt, Moscow, and New York were at the peak in 2008 at the same 4.75 level. Hearing on your risk gut feeling, is it true that Moscow show, just from a mathematical approach, the same risk like Frankfurt? I'm not sure. And this is again for me a really healthy signal. Okay, it's slower than 4, no doubt. Maybe we will see a 2.95, which is another story. But I'm really optimistic that this is again a healthy situation. Saying that, behind all these thoughts, some of you might know what's going on here. There are just 1 or 2 really purely office buildings. The rest, and this is the pipeline between next year and 2017, this is what we call the mixed use or the campus effect. And this is, I wouldn't say a brand new topic, but it will change our market dramatically when it comes to transactions, of course, when it comes to investments approach, investment strategy for all of us here in the room. I don't want to stick out something. Gateway Gardens, of course, long-term thing. Niederrad, which is Living Lyon, which is a conversion into Resi, office into Resi. The big one was last quarter, Geldgroup, the long story with the Polizeipräsidium. But again, you see, this is a simple office or a simple Resi, but most of them are really mixed use. And the good thing, from my perspective, coming from a strategic approach, from an investor's approach, it's not that Märchenviertel anymore. I'm still absolutely optimistic on Eschborn. We will hear maybe later on the huge development, what's going on there from Gensler, but most of these developments, nearly all of them, are at the city center, and then at what behind or beside Mr. Draghi's office tower, which is was an absolute undervaluable market 5 to 10 years ago. Fantastic in my little research world, positively speaking, by the way. And again, some slides at the end to the vacancy rate. Vacancy, I don't want to bring it if it's 9 or 8%. It's a healthy situation because the office, the vacancy rate, it's melting like ice in the sun, not due to the good economy, which is a good thing, by the way, but most of the decline we faced when it comes to conversation from old office West End into what we called high-end urban luxury living in the meantime. So this is the market reacts dramatically positive on that. Office rents, again, this is of course a signal and a symbol and an alibi for the good booming market. I have sometimes made out if the Frankfurt people, we are not as long as dominant just running from this financial service sector, which is our little world, maybe direct or indirect, but we should really bear in mind that 42% of the whole GDP in Frankfurt is driven by what we call the airport, Fraport, and Lufthansa. So don't forget this. 20%, meanwhile, it's under the box called intranet exchange. All these digitalization effects on that, and the rest, it's that normal industrial backbone, by the way. So dominant financial industry, but then really followed by what we call the logistic slash Fraport effect on that. Maybe last slide, nearly last slide. Rumors, headlines, and it makes you depressing just bringing all the FAZ articles together and say, okay, let's count, simple thing, let's count all these people who come to Frankfurt announcement by London. And self-critically speaking, I think, Richard, 2 years ago, we make a presentation here, and they were super optimistic. Of course, for you pessimistic, would say, oh, poor Richard, but the Frankfurt, 20,000, 25,000 will come to Frankfurt. Relatively speaking, this is maybe a big question mark, but this is a measurable thing, UBS, Citigroup, and then the Japanese cluster, which is not as much as expected. Again, self-critically speaking, but what is important for us, an interesting thing, that most of these activities really are now focusing on this little quarter here, which bring us, in my understanding, from an analytical standpoint, this will be the new plateau for a new price level for the time being. This is exactly these 200, 400 meters just around here. There are expectations in Bockenheimer, no doubt. But again, this is again, by the way, we'll move next week to this Marienbogen Catella from FBC on that, so we are in line with that. But again, realistically speaking, we see that this will be obviously the hot thing for the next 10 or 20 years. And then again, do we expect more to come? I don't just follow these super serious Morgan Stanley, Catella research, SEB forecast. You have to also read local press, letters from bankers' ladies, there is a cool blog which is called, in London, which is called Notting Hill Wives. Okay, it wasn't a blog by the internet, which is good, so like Catella, but if you read this, and there are obviously, it's not a fake thing, by the way, it's a realistic thing, you see them by pictures, and there is some ladies from bankers and who make a trip in March and April to Amsterdam, Luxembourg, Paris, and Frankfurt. Again, go on that, find our Google. It was a disastrous result for Frankfurt, obviously. They love, of course, Paris, and this is not a stereotypic chant thing, no doubt. But they like coming from London, more Paris than Frankfurt. I have to say this as a Frankfurt guy. Sounds clear, but as a Frankfurt, I have to show all the flag and say, okay, come our little city, which is okay. Anyway, I see. Last slide, Catella thesis for this year: increasing risk willingness. Let's say storytelling on that. What is important, if you see this, I think there is no big volume going on to third tier or C and D locations anymore. These are headlines. And when we read something on Viechtach in der Oberpfalz, I get nervous and say, oh, this is the British investment company. No, this is most of the time 9% part of big portfolios. And we all know that we are now in the last phase of a cycle which is driven by big portfolios. Simple thing, you get one tower in Frankfurt, a big one, famous super trophy building, but you can also 4 towers in Biberach, in Bad Viechtach, and but what I have never heard before. And this is the situation, so the risk willingness increases, so as a single asset, you wouldn't buy Viechtach, but as a combination, and this is again, we're coming to my first comment on that, I'm a little bit more optimistic than I was earlier this year, beside the economic scenario. And this is again where there are some clouds on the horizon, no doubt, on the capital market thing, but I'm a little bit more optimistic that we will see a new nearly record in the transaction volume for by end of this year. Again, when we call value add or core plus, whatever, and the development thing, this is of course enlarged the investment activity. We follow a lot of investors, also Catella, by the way, who goes meanwhile direct in the developments, which is again another story comparing to the good old world. Just go in and buy a property in the middle of the city center. Again, I will call it a special boom. By the way, again, it's a foggy thing right now, but I can imagine that Q3, especially when it comes to the summer expectations, share deals. Forward things will be good, in my understanding. Negatively speaking, we see an increase in the office rent due to the demand, the lack of product on the other hand, and this is the reason why you see all these co-working thing. Co-working, it's a buzzword, it's headline, but it's a poor thing from an analytical standpoint. In Frankfurt, beside all the big names we all know, we have around 1.5% of the new developments are covered by these what we call co-work. I wouldn't say this is nothing, but it will increase, but it's coming from a 0 level. And so again, we're still living in a world of a 10-year, 5-year lease plus option, no doubt. But it's okay that we see a new peak in the country, as we say in Germany, but I'm not as optimistic that the market will change dramatically within the next 5 years, 10 years maybe. I like these say, co-working things, but on the other hand, we should really focusing where the value really comes from, and it comes from a 10-year lease on that. Anyway, big mixed-use property, just seeing, again, coming back to these developments here in Frankfurt. Modest further compression. Again, maybe there is one investor, I have no idea, but who will give an announcement and the FAZ or Property U and say, I still believe in Frankfurt, so I accept 2.5% city center Frankfurt office tower, 100,000 year lease with Linklaters. I don't think so, but maybe it could happen. And this is again where you see, in my little words, meanwhile, some, let's call it some interesting stories why they make this deal. Positively speaking, by the way, but interesting means out of the traditional box where maybe most of you are in on that. Interesting for business, by the way. And again, rising transaction volume. This is not maybe, or was not my topic here, but it's worth to mention that will be meanwhile number 3 here in the transaction volume for the time being. That's it. Thanks a lot.
Thank you.